All right.
Clapping
Thank
for everyone.
you for that wonderful introduction. And Zaya, thank you for this opportunity to be able to speak at this elevation, your estate. It's really a great opportunity for everyone. And to all the amazing speaker, wonderful. I've gotten so much information down and they're so useful. Thank you to Dr. Donner, Christiana, Chi Chi, and Dr. Joe. I'm truly blessed to be part of this panel. So today I'm going to be talking about tax strategy for small business owner and also for high earn income. I'm not sure if you can see my screen. Let me know in the chat. Can you see my screen or no?
We can't see the
Not
screen
yet.
yet.
Okay, no, okay. So let me share. All right. All right. All right, so today I'm going to be talking about tax planning strategy for small business owner and also for high earn income. And before I proceed, if you remember during Chichi presentation, she talked about your career and now it's related to your income, where you live, and all that. It's very paramount when you earn this money. How do you preserve it? How do you minimize the taxes, right? Because the IRS is out there to actually get their part from their money. So how do you minimize it? The taxations, right? We all pay taxes. That is one thing we all need to keep in mind, but it is how much do we pay back to the government? So I'm going to be sharing a few strategies that you can actually benefit from as you prepare for the tax season or the upcoming year. All right. So here's the agenda. And what I'm going to be talking about is differences between tax evasion and tax avoidance. They're two different things. Tax deduction versus tax credit and tax planning strategy. All right. And common mistake that we tend to make as a small business owner and I earn income. All right. So first is what is tax evasion? All right. So tax evasion is concealing income under reporting your income, meaning basically you're actually under reporting your income, which is illegal under tax law. You're probably wondering, why am I talking about tax evasion? It is because most of the time when we earn this money, we always feel like, oh, I don't need to report this much. All right. But the truth is, there is a way to actually go about it to minimize your tax liability in a legal way. All right, so I'm just going to run over my presentation. Tax evasion is deliberately underreporting and omitting your income. You do not want it to do that, or keeping two sets of books, or making falsified entries in your books, or claiming forced or overstating deduction on your return. All right, we don't want to do that. All right, when we're doing our taxes or when we're planning on tax liability. So now, what is the proper way to do it? What is the legal way to actually do this, right? It is called tax avoidance. Tax avoidance is a legal way for you to reduce your taxable income while increasing your cash flow to build wealth. It is completely illegal and it is encouraged even by the Internal Revenue. And that is what we're going to be discussing today. How do we legally reduce our tax liabilities so we can build wealth? We can build wealth. So example of tax avoidance are ways to legally reduce your tax liability. And before I proceed, I'm going to be explaining some concepts just to kind of have like introduction. So these are introductories. What is tax deductions and tax credit? Tax deduction and tax credit, both are used to reduce taxes, but in a different ways. All right. What is tax deduction? Tax deduction reduces how much of your income is subjected to taxes. Deduction lower your taxable income by the percentage of your IX federal income. All right, so you're probably wondering, what is this mean? What is tax deductions? Tax deduction is the set amount that the government usually gave you every year based on your tax filing status. We have what is called standard deduction, which I'm sure most of us are familiar with, and we also have what is called itemized deduction. Itemized deduction is, standard deduction is a fixed amount that you can deduct from your taxable income, which is based on your filing status, which is if you're single, there's a set amount that the government gave you that you can use. If you're married, there's a certain deduction you can take. And this is the deduction for this tax year that we're going into, right? Pretty much everyone has a set amount based on your tax filing status. All right. Now we have itemization. Itemization is actually you telling the government, say, look, based on what you gave me, I have more than that. I have other things that I needed to claim. So yeah, you have your mortgage interest. All this fall into your itemized deduction. You have your state and local state taxes. If you live in a state like Illinois, Boston, which you pay state taxes, these are tax deductible. You have your medical expenses, your charitable contribution, which is very important. You also have your certain business expenses. All this accumulated to itemized deduction. If you exceeded the standard deduction, you can take itemized deduction instead of the standard deduction. Let's say, for example, you pay $10,000 in mortgage interest and your state taxes is $6,000 and you have charitable contribution. That comes to a total of $18,000. If you're single, that exceeded the standard deduction that the government gave you. And this is just an example. There are people that their mortgage interest is close to $30,000. And if they're married, that automatically extended the standard deduction that the government set aside. So you wanted to make sure as a taxpayer that you take advantage of itemized deductions. You want to keep your receipt if you don't, and you want to also keep in mind things that fall under itemized deductions. All right. Now, what is tax credit? Tax credit is different from tax deduction. We just talk about tax deduction. Tax credit is a direct reduction in the amount of taxes that you owe. In my next slide, I'm going to show the example. We have two different types of tax credit, non-refundable and refundable credit. Non-refundable credit are credit that apply to your tax liability, but they necessarily will not give you a refundable amount back, but they lower your taxable credit. While refundable tax credit reduce your tax liability to zero, and if there is any amount remaining, you get it as a refund. So technically, you can see the difference. So when you hear people say, no, I'm getting this amount of money back, it's not that they're getting that amount back. It's based on their refundable tax credit. All right. So there is different type of tax credit that you guys were familiar with, which is a child credit, your EIC credit, educational credit, energy efficient home improvement. If you made an improvement to your home, such as installing solar panel, their tax credit for it, I believe in the last few years, is based on the amount. You can get a minimum of $9,000 back based on the installation of the solar panel. You have adoption credit, child and dependent credit. This can result in refundable amount, all right? Now, here is an example of tax deduction versus tax credit. So if you have an AIG, let's assume you have an AIG of 100,000, all right? Tax deduction, basically, you have that $5,000 minus that 100,000 and your taxable income, which is 95,000. It's lower rate before your tax bracket, right? While tax credit applied after your taxable income. And you can see the differences in tax due if you have to pay back, right? Now, so I'm going to proceed to the main topic, which is tax planning strategy. What is tax planning strategy? It's the process of organizing your financial affairs in a way that minimizes your tax liability while ensuring compliance with tax law. It's involved strategically planning and structuring your income, deduction, and investment to take advantage of tax benefit, credits, deduction to reduce the amounts that you owe. And Dr. Johnson, she just talked about real estate. And I'm going to actually bring out, you can use real estate as a tax strategy to reduce your taxable income in the long run, right? Now, the first thing in tax planning strategy is evaluating your business entities. What type of business entity do you have as a business owner, right? Because most of the time, the mistakes we make as a business owner or I earn income is we do not understand the business entities that we choose, how it affects our tax liability. Assuming you start a business and you assess that this business, the longevity, the growth level of the business, it's allow you to properly think, do I need to just form a basic LLC or S Corp, elect as an S Corp or partnership or a C corporation? Often than not, as an entrepreneur, we don't think in that longevity. Once we have the idea, we're passionate, we're just forming an LLC. We don't think about the growth level of the company. How far is this business going to grow? How far am I going to invest in this business? So I can plan around that business to be able to build wealth, right? So most of the time we just start and we just from LLC. And basically LLC only protects you on a state level, not on the IRS level. When it comes to the IRS, you're just so prompt, meaning that you still report your income, your expenses under your 1040. All right. And most of the time, the deduction when it comes to SOPROP, your LLC, your basic LLC, it's very, very limited. And it also exposes you to audit. Assume you build the business, you grow the business to the level that the business is over $250,000, and you're still under LLC or SOPROP, and you're still reporting on your 1040. Just assume that, and you put in all the deduction at the end of the day, so your net profit is $50,000. Even if it is, you are more likely to be audited because IRS are looking at your return. How can you gross $500,000 and you're telling us your net profit is $50,000? It's not realistic, right? So it's very important when you're building your business to consider your business entity is the number one foundation in tax planning. And most of the time we don't think about it, all right? Now, this is a chart that actually gave you an example of single member LLC versus S Corp, right? Now, let's assume you the business grossed $120,000 in revenue this year, and you have, this is just hypothetical, you have 20,000 business expenses, your profit is 100,000. Now there's something we call self-employment taxes that a lot of small businesses with sole prop, single member LLC don't realize is that you have self-employment taxes. All right, the self-employment taxes meaning you are paying the taxes as an employer and also as an employee. All right, and your taxes are much likely to be much higher. All right. Now, if you elect as an S Corp or C Corp, your tax liability will be much smaller. You could see from this chart the differences in the taxes. Okay, and now not only that, S Corp actually allow you more flexibility to take more deduction than your single member LLC. All right, and then maintaining a proper accounting book, such as copy of your receipt, is very, very important. After evaluating your business entity, the next thing is keeping a proper accounting book. It's really, really critical because if you don't keep a proper accounting book, it's difficult for you to be able to say, this amount was spent toward my business, all right? So it's very, very important. All right. All right, another thing is in tax planning strategy is maximizing your retirement contribution. Often than not, we don't pay attention to this. all right? But it's very, very important. As a small business owner with solo 401k, you can contribute up to $46,000 into a solo 401k. All right. And also for SEP IRA, you can contribute up to 53,500. So you want to take advantage of your retirement account as a tax planning strategy as a small business owner. And even as high income earners, you also wanted to make sure you are taking advantage of your 401k at work, because most of the time your employer tend to match your 401k. And if you're not taking advantage of it, you're not maximizing it, you're actually leaving a significant amount of money on the table. So it's very, very important. Another tax strategy is hiring your kid. Now, this is very common. I mean, a lot of people talked about it. As a small business owner, you can hire your kid and pay them up to $14,600 without having to pay Medicaid or Social Security taxes. This figure tends to change every year based on the standard deduction. As long as the amount is it's up to is as long as the amount that you are paying your child is not higher than the standard deduction that the government set aside, your child do not have to file taxes on that amount, and this can save a significant amount on you lowering your tax liability. And when you're hiring your child, you probably are wondering, okay, what do I need to do that? You just need to you need to give them an actual job that your child must perform in that necessarily work. It doesn't mean they have to be at work, but at least if you hire someone, you usually have a list of what they need to do. So you wanted to do that for your child as well in case an audit happen, all right? You also wanted to make sure that you pay a reasonable salary for your kid, and also keep good record keeping when you are doing that. You just don't want it to do it in a way that you won't be able to account for it. You have to go through a payroll company to be able to do this. And depending on your business entity, it's, depending on the business entity that you elect, is also pay significant amounts in you paying your child. If you're a single member LLC, there's a law that you don't have to pay your child. You don't have to pay Medicaid and Social Security taxes. But if you're an S Corp and you hire your child, or a C Corp, then you have to pay Medicaid and Social Security taxes. All right. Another tax strategy planning is contributing to your HSA, which is known as health saving account. Most of the time, we don't take this thing as important, but this can lower your pre-tax. All right. And this money can grow tax-free. So as an individual for 2025, as we go into the year, you can contribute $4,150 to your HSA, and as a family, you can contribute $8,000. And even as a small business owner, this amount is also deductible in your gross income when you contribute to your HSA. This is very important. You want to think about that. As high earner, you also wanted to make sure that you're taking advantage of HSA in dependent child credits from your work that they offer. This allows you to lower your taxes in the long run. All right. Another tax strategy is Augusta rule, which we all know as Section 280, is you actually renting part of your home as an office. For example, I'm presenting from my home. All right. This can be I can deduct this in my taxes. All right. Because I'm doing this, is tax deductible. And basically, Augusta rule is meaning that how do I explain it? You actually bill your company for using your home as an office, all right? And you do not have to report that rental income that you received, but you can write it off as a business expense. Okay. Another one is real estate as tax shelters. Real estate as a tax shelter is huge, right? But I'm not going to be able to cover a whole lot out of it. I'm only going to explain briefly. Using real estate investment to create a tax shelter can help you save on taxes all through many IRS deduction. All right. Now you probably are wondering, how would this help me? As we all have heard in the past how important real estate to build wealth. Not only to build wealth, but you can also use it to leverage the tax code. All right. Because a lot of things in real estate are practically deductible, your mortgage, your repairs. And every single thing that you spend on your real estate is tax deductible, and it can help you lower your tax liability. All right. And also, as an high-end income, there is a special rule that allows you to take up to 25,000 deduction, all right, to be able to lower your taxes. But you wanted to make sure that you qualify as a professional real estate, meaning that you are actively involved in the real estate, not just as a passive. Yes, real estate is a passive income, but you want to be involved actively while doing that to be able to take advantage of that $25,000 deduction. And also using your primary home as a tax strategy can be very useful. I think my time is going, so I'm running through different tax strategies for you guys. Then we have what is called tax loss harvesting. And this is pretty much when you invest in the stock market or your mutual fund throughout the year, you notice there is a stock that you are losing money, you can sell it during the year to be able to take advantage of the losses to also lower your tax liability. All right. We also have deferred or accelerated income. Let's say, for instance, you are a small business and you know that a major income is coming in at the end of the year that could significantly increase your tax liability. You can choose to bill that invoice the following year. So you can take advantage of tax, of tax deduction, or you can accelerate your deduction purchasing certain equipment during the tax year, so you can take advantage of it. If you realize that your tax liability is going to be high, purchasing equipment, new computers offering bonuses to your employees, so you can take advantage of tax liability. Would you rather give a bonus or pay it back in taxes, right? When you offer bonuses, then you have loyalty employees. They are willing to work hard. All right. And the major one is still leveraging business write-off. What does this mean? Under Section 162 code, on that Section 162 of the Internal Revenue Code apply when collecting federal taxes, is the fact that every businesses are different, every industries are different. There are certain there are certain deductions that are peculiar to your business that is different from other people's businesses. So you want to understand your industries and what's deduction that is actually pertain to your business. According to this code, it's meaning that any expenses that you incur that is ordinary and necessarily to your business can be deducted. All right. That is what that code is all about. Like, for instance, you have someone in real estate versus someone that is in financial industries. Their expenses, their deduction could be quite different based on the needs of their businesses. Or let's take, for instance, a real estate in California versus someone that work in Texas, right? Or a real estate in Texas. California is image and entertainment and all of that, and physical look, it's highly important. The poise is important. And you said, I invest so much in my look, and I'm taking that deduction. It's allowable if it allow you to earn businesses. This is what this code specifically deal with making sure that you leverage your business right off. Anything that allow you to earn, build your business, grow your business, you can be deducted, all right? As long as you keep your receipt and you keep a written note.
Okay, Mr. Deol.